Hey, Alex here for Chapter 2 examples. So this is exercise 2.9, transactions and T accounts. So this is a quick little problem, very basic, but just to show transactions and how the correct way to do certain ones and the T accounts associated with them. So here on the first one, number one, we billed customers for fees earned, and it was 35,700. So the journal entry, and journal entries are very important because that's kind of how you connect and really understand accounting. So here's the journal entry. When you bill the customers for fees earned or services performed, you debit accounts receivable for 35,700, and you'd credit fees earned for the same amount, 35,700. And basically that means you've acknowledged you've performed the duty, you've earned the money, and you have a claim to that money. So it's not cash yet, but it will be soon. Normally 30 days, net 30. So if longer, you'd probably have them sign a note and charge a little bit of interest. So that's basically it. You've acknowledged your claim to an asset, cash, and the revenue account. And then I'll show you the T accounts at the end. But here's the second one. Purchased supplies on account for $2,000. And so the entry is you debit supplies, it's an asset, just like the accounts receivable was. It's an asset, so you're going to debit it for $2,000, and you're going to credit accounts payable for $2,000. Because remember, you bought it on account. So you're crediting accounts payable for $2,000, debiting supplies. So you're getting an asset, but you're also getting a debt. And you'll pay a payable off in normally 30 days, net 30. If you need more time, it'll be a notes payable, and you'll sign a note, and you'll maybe be charged a little bit of interest to have more time to pay. And so that's what you get. You got your supplies and got your payable. So you got an asset and you got an obligation to pay it. Because remember, if the only way you could buy something was with cash, it would slow down business. It would slow down the economy. It makes no sense to only be able to buy with cash. You have to be able to be willing to accept credit. So the third entry is received cash from customers on account, $26,150. So now they've paid us so we billed them for the 35,700, and now some of them have paid us. So we're getting some money back. So now we're debiting the cash account and we're crediting the accounts receivable account. So we're turning that receivable into cash. We're crediting accounts receivable, debiting cash. So now we're making the money. We're turning one asset into another. So we're flipping it over. We're finally turning over our receivables. Very important to do. Sometimes you might not collect on everybody, but we'll discuss that